In 1995, two brothers inherited the same $50,000. One bought a rental house and worked on it for 30 years. The other made one investment, automated $300 a month, and tried to leave it alone. 30 years later, the brother who did less had roughly $856,000 more. The investment sold as passive had demanded more work. The investment that looked effortless had demanded more discipline. That should have meant the answer was simple: stocks beat real estate. It wasn't. The real difference was not just the asset. It was the part almost every calculator leaves out: the owner. This is the Ben factor. Marcus and Daniel are twin brothers, both 28 in 1995. Same city, same salary, same $50,000 inheritance from their grandfather. Their grandfather repaired houses for 40 years, giving most Saturdays to somebody else's property. Once, he used scrap pine to build a small wooden house with the twins. Marcus remembered the house. Daniel remembered the Saturday. Marcus buys a $150,000 rental, puts down $50,000, and borrows the remaining $100,000 at 7%. His payment is about $665 a month. A tenant moves in at $1,100. On the first spreadsheet, Marcus appears to have found $435 in monthly cash flow. Daniel puts the full $50,000 into a low-cost S&P 500 index fund, automates another $300 each month, reinvests every dividend, and keeps working. Marcus owns a building he can drive past. Daniel owns a number on a statement. I expected Marcus to win. Leverage, rent, appreciation, tax advantages. The case looked almost unfair. If rental property really was passive income, he should pull ahead quickly. He did not. For 8 years, Marcus gets the landlord story people imagine. His first tenant pays on time and handles small repairs. The house appreciates. Marcus talks about equity at dinner. Daniel mentions an index fund, and people change the subject. Marcus looks like the investor. Then, in year 3, we compared the cash flow calculator with Marcus's bank account. He collected almost $40,000 in rent. Mortgage payments consumed about $24,000. The quick calculation showed roughly $16,000 left. Then came tax, insurance, vacancy, a water heater, cleaning, and contractor bills. After the real costs, 3 years of landlording had added barely $3,000 in usable cash. The spreadsheet said 16, the bank account said 3. Daniel's account had grown to roughly $80,000. No tenants, no contractors, no Saturday appointments. That was the first assumption to break. Rental income was real, but passive was the wrong word. Every asset has maintenance. The hidden question is what kind? Marcus maintained a property. Daniel would eventually have to maintain his nerve. We thought that explained the difference. It didn't. That became clear in 2008. When the economy collapsed, both brothers faced a crisis. It simply arrived through different doors. Marcus's replacement tenant lost his job and the rent stopped. The mortgage did not. Neither did taxes, insurance, or repairs. Marcus sits at the kitchen table, children asleep upstairs, moving family savings into a house that was supposed to produce income. 4 months of missed rent follow. The house never displayed a red number on a screen, but Marcus experienced his own private crash. Daniel's crash was visible everywhere. He opened his account in early 2009 and saw it down 37%. In 12 months, the market had erased more than the original inheritance. He hovered over the sell button for a week. Headlines and coworkers told him to sell. Doing nothing felt irresponsible, so he called Marcus. Daniel explained the loss and the button. Marcus listened from the same kitchen table. Then Marcus said, "At least you can get out with one click. I'm stuck with mine." He meant it as frustration. It became the best investment advice Daniel ever received. Marcus's house survived partly because it was difficult to sell. Illiquidity forced him to stay. Daniel had the opposite problem. Liquidity offered him an exit every second. He closed the laptop, kept the automatic $300 running, and did nothing. That was the second assumption to break. Index investing is not effortless. It replaces physical work with emotional work. Stocks ask, can you remain still when every signal tells you to move? Real estate asks, can you keep showing up when every problem demands attention? Neither investment is passive. They charge in different currencies. By year 10, Marcus's house is worth around $231,000. He still owes roughly $86,000, leaving about $145,000 in equity. Daniel's portfolio is around $190,000. Daniel is ahead, but Marcus used $50,000 to control a $150,000 asset. Leverage, depreciation, and tax deferral are real. We kept going. By year 15, Marcus has about $213,000 in equity. Daniel is near $328,000. By year 20, Marcus is around $299,000. Daniel is close to $552,000. The gap is widening because compounding has crossed a threshold. Daniel's gains are now creating more new wealth each year than his contributions. Marcus's property is compounding too, but so are its demands: vacancies, repairs, insurance, taxes, decisions, and time. A roof, furnace, 2 water heaters, and a flooded basement add almost $20,000. None of these destroys the investment. That is why calculators understate them. They survive as separate line items while accumulating into a second return nobody displays: the effect the investment has on the owner's life. Each cost arrives alone. The owner experiences them together. We thought that was the missing variable. It wasn't. One comparison remained: every dollar Marcus had built against every dollar Daniel had left alone. The missing variable was not risk-adjusted return, it was owner-adjusted return. After 30 years, Marcus owns the house outright. It is worth around $550,000. Across 3 decades, he collected roughly $580,000 in rent. The mortgage required about $240,000 in total payments. Property taxes took about $108,000. Insurance, vacancy, routine maintenance, and major repairs absorbed another $146,000. After every modeled cost, Marcus kept about $86,000 in cumulative cash flow. Add that to the paid-off house, and Marcus finishes with roughly $636,000 in net property wealth. That is an excellent outcome. Real estate did not fail him. Many investors would be thrilled with that result. It simply produced a different outcome under these assumptions. Daniel's $50,000 plus $300 a month for 30 years grows to roughly $1.49 million at a 10% modeled return. Same inheritance, same starting line, a difference of roughly $856,000. But the headline still hides the most important fact. With several well-managed properties and deliberate leverage, Marcus could have beaten Daniel. Real estate is not the losing asset. It loses when the owner wants business-level returns from hobby-level systems. Daniel's result also depends on behavior. One click in 2009 could have destroyed the entire ending. The index did not win because it demanded nothing. It won because the demand matched Daniel better. Marcus built wealth by answering the door. A tenant left. He answered. A pipe burst. He answered. The roof failed. He answered. Daniel built wealth by refusing to answer a different invitation. The market crashed. He did not sell. The headlines changed. He did not chase them. His friends bought other things. He did not follow. Marcus's discipline was action. Daniel's discipline was restraint. Only then did the pattern become clear. We began by comparing returns. Then leverage seemed to explain the difference. Then cash flow. Then taxes. Each answer was partly right. None was complete. The calculator could not know which system each brother could continue through 30 years of stress, temptation, interruptions, and ordinary life. That is why asking which investment is better produces endless arguments. It removes the investor from the investment. The better question is, what will this asset demand from me, and can I keep paying that price for 30 years? Because every investment produces two returns: the money it creates and the life it requires. Their grandfather spent a lifetime giving Saturdays to other people's houses. Both brothers believed they inherited money. Marcus built tangible wealth through service and responsibility. Daniel built an invisible system that asked for patience instead of weekends. Marcus remembered the little wooden house on the workshop shelf. Daniel remembered the Saturday they built it. Neither memory was wrong. They simply led to different prices. The honest answer is not that index funds always beat rentals, or that real estate is the only path to wealth. Neither is true. The best investment is the one whose demands fit the person you can realistically remain for decades, not the person you imagine you will become next month. The person you are when markets collapse, tenants stop paying, life gets busy, and quitting becomes easy. Marcus built wealth by opening the door. Daniel built wealth by leaving one closed. The difference was never just the return. It was the cost of earning it. That's the bin factor.